watching The Money Show. I'm with you, Kavita Thapliyal, and this is the Women's Wednesday edition where every Wednesday we talk about women investment strategies, help our women viewers, investors navigate through all of their financial decisions and investment strategies. And just in case you also want to get your question answered on this particular edition of our show, send across your question on the email ID that's flashing on the screen. You can also WhatsApp us your queries on the number. Just send us the required details in terms of your investment strategies, your current investment strategy, and your financial goals. Or if you're someone who hasn't yet started investing, you want any guidance from our experts, we can get you all of that. We are joined by Harshvardhan Roongta, who will be answering your portfolio queries today live with us. Harsh, hi, good evening, and welcome to the show. And lovely set of questions, I must say. And let's start with the most interesting one. This is Meenakshi from Kerala, and she says that she wants to buy a house in 5 years. She has accumulated 3 lakhs and her husband has accumulated 5 lakhs. She wants to understand if they should be taking a joint loan, because she says that her husband, he's in a stable job, but she might be quitting as because they are planning a family. And so she wants to take a loan of almost 50 lakhs. How can she go about it? Because, you know, she quitting her job can add more financial pressure on the husband, and plus there'll be a pressure of the loan as well. So how can she navigate a very important decision, a very important life decision, Harsh, that a couple takes at this particular stage of their life? How can the right step of financial planning can help them, solve a lot of other issues in life that can come later on financially?
Well, Kavita, this is indeed interesting because currently they're a couple working together, working and earning. Now, when after 5 years, when she's intending to take a loan, the eligibility of the for the loan will be considered based on the occupational details of the people at that point in time. So, in case in she is going to take a break and not be working during that period, the income of the husband alone will be considered for evaluating the eligibility of the loan. While she could be a co-borrower or the guarantor in the loan, the bank will only assess the income of the husband at that point in time, and check and let you know the eligibility. Now, with regards to availing a 50 lakh loan, well, how the bank looks at the eligibility, one of course is the property value. The loan cannot be exceeding 80% of the property value. That's one side of the story. The income eligibility works in this way. The bank assumes whatever is your net take home salary, you would be able to use 50% of that towards payment of EMI. So, in case you're looking for a loan for 50 lakhs, the bank would at least want to see that you have 1 lakh worth of an income, so that 50,000 rupees you can use for payment of EMI, and a 50,000 rupee EMI would essentially get you a 50 lakh loan. So that's going to be the assessment, the process which you need to make the planning. And in case you believe that 50% of your husband's income is more than 50,000, then less than 50,000, then you will have to most certainly either lower the loan requirements, or you may even need to delay your home purchase. Why? Because in terms of the cash flows, there's going to one income is going to stop, which is you're not going to be working. Currently, both of you are working and life, but one income is not going to be there with you not being in the workforce. You're going to have a child, which of course will increase your expenses, and you're going to have an EMI burden. So you'll have to evaluate from this angle, that one income going away and two additional expenses coming up. Is that a wise decision at this time? If not, then the easiest thing to do would be to postpone the house purchase for a couple of years. When you get back into work and you also start earning an income, then at that point in time, you could possibly look at buying a house.
All right, a very important decision. So please be mindful about it. Please have all the conversations, that are necessary to sort this aspect of your life together with your husband. And definitely, Harsh, because they are also in a life stage where they'll be needing a lot of financial backup. Is there anything that you want to advise them in terms of keeping their investments on, just in case they do not have it yet?
So, well, at every stage in life, there is going to be a requirement to invest, irrespective of the amount. So, you could be in a situation wherein your expenses are just about equal to your income, when you feel that there is no excess surplus left for me to invest, even in such scenarios, we normally recommend that you start investing a small amount. It could be a 500 rupees a month, it could be 1,000 rupees a month. Never be out of the process of investing. So it could be a small amount that you're investing today, but you're in the loop, you're in the cycle of investments. As in, when your cash flows improve, you can always make it better. So, the problem would be that if a person has not been investing at all, even 500 rupees a month, for example, and then to start all over again, it might just take a lot of effort and time, or maybe it just that doesn't really come into the priority list at all. So, at all stages in life, you will need to make sure that you maintain a financial discipline wherein there is some investments going. Now, in this one particular case, you're expecting a new family member to come in the near future. So, most certainly, your expenses are going to go up. So, you'll have to plan your cash flows. You'll have to plan certain investments right now when both of you are earning, because there is going to be a period when one member is not going to earn. So, you will have to maximize your savings right now for that period, or at least a couple of years when the mother will not be working. So, you'll have to make up for that in present times so that you can have a comfortable cash flow even then.
Okay, let's move on and let's take this other interesting question. This is from Rinku, and she wants to know what kind of expectation should we be having from mutual funds return? Okay, interesting question, and the kind of times we are into, which are so chaotic, one must question the kind of returns they might expect or get from mutual funds. But having said that, Harsh, expectation setting is very important before you get into any asset class. In fact, even before you start your process of investments, it's one of those phases or those crucial homework that you might want to do before you think about, what to do with the corpus. So, across asset classes and not only mutual funds, how can one have realistic expectations?
Yes. So, Kavita, this is actually a very important question, because when you're investing into mutual funds, as per regulations, the fund houses are not allowed to give you even an indicative return that an investor can expect, because both the equity and debt schemes are market linked. So the returns that is being generated are, you cannot really know exactly in advance as to what kind of returns an investor will get at the end of the investment period. However, to solve this gap, why? Because while you're making an estimation, while you're making a plan for yourself to achieve certain goals in the future, say you're planning for retirement, for example, you were certain that you need 5 crores at the end of 30 years. So you will need some figure to assume that if your investment generates an X amount of return, then how much do I need to invest every year? Now, to solve that problem, AMFI in November 2023 came out with certain guidelines wherein to help investors plan for the future, an indicative returns or an assumed rate of returns for illustrative purposes were given to standardize the entire process. Now, I just reiterate and make an emphasis on one point, that the returns that have been indicated in that circular are no way indicative of the point that an investor should think that these are the guaranteed returns that a mutual fund will give, or these are the returns at least what they should expect. Now, this is only for the purpose of an assumption based on certain past returns, and the actual returns that an investor may get could be very different from what has been mentioned in that circular. So please do not indicate and link your returns to that circular. It's only for an assumption purposes for an investor to assist an investor to plan. Now, if you're investing into equities, the circular says that you could assume, or rather, you could, for illustrative purpose, consider that you'll get about 12 to 13%. Obviously, this can differ in actuals. If you're investing in debt schemes, 7.2%. Aggressive hybrid fund, the range has been given from say 11 to 11.5%. If you're investing in balanced funds, which has equity and debt in equal proportion, it is 10%. If you're investing into multi-asset funds, which has equity, debt, and precious metals, you can assume about a 9.8%. So this is very indicative for an individual to plan and assume a certain corpus that they will accumulate in the future. But these are not the rates, or the intent of AMFI is not to tell you that these are the returns that you will get, or it could be very different in reality. But because you need to get some number to design your plan, these are the indicative returns that you can assume for illustration purposes.
Let's move on and let's take this next question. This is from Zeenath, and Zeenath is wishing us happy Eid. Zeenath, wishes to you as well. So Harsh, she wants to know about the best flexi cap, and she says that everyone seems to be buying Parag Parikh flexi cap. So what's so special about the fund, and also how can you decide the best fund in flexi cap category?
So, well, Kavita, there are so many factors that have to be considered before you pick any scheme. Right? There are qualitative factors, there are quantitative factors in the form of some ratios that you will need to see how much risk is the scheme taking, what is the return it is generating per unit of risk that it is taking. Unfortunately, investors tend to only look at past performance based on some online portal comparisons and just pick the scheme which is performing the best in the recent past. That's really not the way how you would select a scheme. There are so many other parameters that you have to look into. Now, with regards to the fund manager, well, the best of the fund managers with long history of good performance may also have their cycles. You will see that at one point in time they've done very well, and the other times, despite everything being done correctly, the markets haven't responded to their calls, so their performance has not been that great. That doesn't mean the fund manager is not good. So they could just take their own time for turnaround, and it would reflect in the returns over a period of time. So there are lots and lots of factors that go into selecting a scheme, not just simply looking at past returns. Now, she's spoken about FlexiCap. Now, let me take two schemes within the FlexiCap category and explain how they can be different in their own approach as well. Now, if we look at Parag Parikh FlexiCap, and we compare it with, say, HDFC FlexiCap. Now, Parag Parikh FlexiCap has an AUM of 1,30,000 crores or. Now, their cash holdings is about 20%, which means 80% of this 1,30,000 crores has been invested into stocks. They bought into shares, and that's their holding. 20% of that money is lying in cash, waiting to be deployed in the market. And the fund management team apparently believes that markets will be subdued, and if there is further correction, they'll get an opportunity to invest further into it. So, for which they need the dry power, they need money in their hand, which they can deploy once the market corrects. Now, that's the outlook of the fund manager. Come to HDFC FlexiCap. HDFC FlexiCap currently has this cash holding of 10%, which means 90% of their money is invested into the markets currently, and 10% is what they've kept as reserves, that if market corrects, they would have some liberty to park fresh money. Now, in a scenario like this, if the markets were to fall from here because war intensifies, etc., and the markets fall down from here, Parag Parikh FlexiCap will outperform because they have invested only 80% in right now, and 20% is still in cash, and they can deploy further. So the losses will be lesser in case of Parag Parikh as compared to HDFC being 90% invested. Now, if the war suddenly comes to an end and the markets rise very sharply, you will see HDFC mutual fund, HDFC Flexi Cap will perform better than Parag Parikh, but purely because of the fact that they're 90% invested into the market right now. So even in the flexi cap category, even amongst the two or three or four best mutual schemes, the top schemes in that category, they would have some attributes which are a little different, and their approach, their style of investing could be different. So what an investor needs to do is to dig a little deeper into the scheme attributes, understand what are the risk ratios, what is the risk that the scheme is taking, against which how much returns are they generating, go into the portfolio construction, maybe, look at for the certain factors. Of course, if you have an opportunity to interact with the fund managers in the investor meets, go and meet them, listen to them, so you'll understand whether your thoughts align with each other or not. So these factors will determine which scheme you should pick amongst the top 5 or 10 in any category. So every category will have at least 5 schemes which are very good. Does not mean the one that shows the top in performance is the best that you should pick. So my point I'm trying to make is, Parag Parikh, no doubt, is a very good scheme. If you're comfortable with it, go ahead investing in it. And that's probably the reason people have been picking Parag Parikh over other schemes. Nevertheless, look a little more deeper. You might find something that suits your comfort, and then pick a scheme. Amongst the top 5 or 10 schemes in any category are a good filter to apply, and pick anyone from, say, probably top 5 or top 10 schemes in each category.
All right, so that's your recommendation coming in for Zenith, and yes, a very realistic approach and a very important understanding, especially this is your initial stages of your investments. You need to get the first step right, Zenith. So, all the best. Let's move on. And again, a very interesting question. This is from Larry. She's a government teacher from MP, and she says that her mutual fund portfolio is down almost 10%, and she is not able to see any benefit of investing in mutual funds so far. And so, mutual fund sahi hai. Her question is how?
Well, actually, this is a very, very common, approach of an investor, especially who's new into the market. So if you've just entered the market, say probably in the last 1 or 2 years, even your SIP returns would show you negative returns. So you might question yourself, thinking whether you've done the right thing, because the common comparison that investors would have, if after 2 years or 3 years they see their portfolio negative, the first thing that comes to their mind is that it would be better if I put my money in fixed deposit. At least I would have got 6% per annum. So these are the things that usually investors are definitely confused with. So the only solution is that you need to, before investing, understand how that product functions. We've been covering this topic on, with the previous queries. Investments in mutual funds are all market linked. Even debt and equity are market linked. So you must understand that if there is any global uncertainty, if the economies that are under stress, for whatever reasons, it is going to reflect into the returns that the markets will generate, right? Markets will fall when there is uncertainty, and they'll go up when there is clarity. The question is, what actually would be a cause of concern would be that there is war that is going on right now as it is, and there is so much of stress on fuel, energy. There is so much of concerns about security, and the war escalating, etc. And markets ignored all this and continuously just kept going one way upwards. That would be a cause of concern because it's not doing what it is supposed to do. Now, when this uncertainty goes away, you will see the returns will automatically start coming back into the market, coupled with the growth, underlying growth of the economy, which means the companies also need to show growth, right? So all this will take time. It's not going to be that war ends, so there will be one reaction when markets go up, but eventually you will have to figure out that the earnings of the companies have to go up, right? So all this is going to take time. If you are not comfortable with this entire time period, with the volatility that equity market offer, then most certainly you should not be investing here. Either you take the effort of educating yourself and understanding what are the nuances of investing into mutual funds, particularly equity schemes. And in case you're not comfortable, then you could most certainly pick schemes or funds or products or fixed deposit kind of investments where you're comfortable. So it's very important before investing that you understand what is it that you're expecting from equity markets, how they function over a longer period of time, and what are the volatility and risk in the shorter period of time. If you understand all this, continue. If not, then most certainly I would suggest that please look at some other investment options which give you comfort and peace of mind.
All right, let's take the last question. And this is from our viewer. She said that she's an intern and she's confused about doing an SIP or a lump sum investment. She's accumulated some 10,000 rupees that she wants to invest. That's the first step of investment. Harsh.
So it's very nice, yeah, in fact, Kavita, to see an intern look to invest whatever she's accumulated, during her internship. I think it's a very positive step, and my congratulations to you for looking at your starting your financial journey right from your internship. Well, my suggestion to you would be to invest via SIP. Do not look at lump sums at this juncture. This is your first step into the markets. So please invest only via SIP. You can pick an index fund, such as an HDFC BSE Sensex Index Fund. To start this journey, you want to invest 10,000 rupees. You can do an SIP of 1,000 for 10 months. So that will be your investment, the application that you will make with the AMC. You tell them that I want to do a 1,000 rupees SIP for 10 months. So this 10,000 will come into equity markets. At the same time, I'm assuming that you will want to stay invested for at least 10 years. Being an equity fund, you will need to give that kind of time to your investments.
All right. With that, it's a wrap on the show as well. Thank you so much, Harsh, for taking time out and helping our viewers navigate through their financial portfolio and their investment strategies today. Thank you so much for joining in. For all our viewers, Women's Wednesday is a very special initiative for women investors, especially just in case you want to be a part of this. Send across your questions on our WhatsApp number and email ID. Thank you so much for watching. Goodbye.